Record. Okay. So let me welcome Angelo. How are you today?
Hey, David. I'm doing pretty good. Hope you're well.
Yeah, I mean, in these markets, it's hard to be well.
Well, there's a lot to be said about that. And, if you want, we can just give everyone, maybe another 30 seconds to come in and I'll just make some general opening remarks about the market, or the flow, as I like to call it, versus the cycle. Because that's always something that people don't understand unless someone teaches it to them.
Can you please mute yourself? Who is this? Jirka. Okay, I will mute the Jirka. Okay.
So we got all our Czech friends here today, huh?
Yeah, it was a great team building in Mikulov. It was a lot of fun.
Look like it.
Okay, sorry for interruption.
No, that's totally okay. So, since you brought up the difficulty of the markets, let's just take a step back for a moment and separate the short term, right, from the long term. And what I learned many, many, many years ago is that there are three movements to the markets. Okay, three movements. The first one, okay. The first one is the day-to-day movement. David, do you have the ability to mute?
I'm muting everyone.
Okay.
Okay. So, I will try for next time to figure out that automatically everybody's muted when they join.
Yeah, yeah. I think there's a function in there somewhere. But anyway, so to take a step back and address, your comment about the difficulty of the markets, there's three movements in the market that everyone should come to understand. The first one is the day-to-day movement of the market, the daily movement of the markets. And what drives the daily movement of the markets back in the old days simply used to be those investors that needed to raise cash, those investors that changed their mind, those investors that started putting money to work, all right, because they changed their minds about longs or shorts. So that's the day-to-day. The next movement of the market is what's called the secondary reaction. So the secondary reaction, most people might call that bear market rallies, right? Or bull market rallies within a bear market, right? So that's number two. So the secondary reactions, that's what we're getting right now. Okay, that's what's throwing everyone off right now. We're getting a pretty strong secondary reaction. And then the third movement of the market is the primary trend. The primary trend of the overall market, of the cycle. Is it bullish or is it bearish? Right now, this is an ongoing bear market, but we are undergoing a secondary reaction, or a bear market rally, as most people come to know it. Now let's just talk about that for a second. So when you think about what the market is doing, the flow, I like to call it the flow, okay? You take the bond market, the currency markets, the stock market, all of these things, I'm just generically calling all of those different markets the flow. The flow is different from the cycle. And there will be times where the flow diverges from the cycle. And everyone, starts to go nuts because, oh my God, the stock market's doing this or it's doing that. Isn't this supposed to be a bear market? Well, there's times where they diverge. And that divergence might last a month, 2 months, maybe 3. It happens. But eventually, the two, the flow and the cycle, converge, and the cycle begins to reassert itself again. So last year in 2022, that was really the first leg of this bear market. And the reason I think now that we look back in hindsight was 2 things. The Fed raised rates literally 500 basis points in a very short period of time. And so you had to have a market reaction to that. Then the second thing was really just the rate of change slowdown in GDP coming off the cycle high. David, what was it? The second quarter of 21 or 21, the second quarter of 21, right? Growth peaked out at 12%. Okay, so no one should, get their underwear in a knot just because the market or the flow is doing one thing and it doesn't agree with the cycle, the data, right? Or the math, as we might call
the macroeconomical cycle?
Correct.
Yeah.
The business cycle, the macroeconomic cycle. Exactly. These things happen. They happen all the time. So as I heard someone say this morning, what did he call it? You can have a view, right? And your view might be bearish, and our view is bearish, but that's different from how you're positioned. So just because you might be bearish doesn't mean you load up on shorts and stay with those shorts at any price. That's where having some of the tools, David, that you offer in Marketimers for understanding the secondary reactions that I spoke about, okay? That's where you have to have an understanding of those 2 things to know, okay, we're getting a secondary reaction, it's to the upside, and I can't sit here with 50% shorts or 40% shorts. You have to get out of the way so that you don't get crushed. And that's the challenge now. That's what I'm starting to see with a lot of, I'm going to call them young investors, and not necessarily young, but I'll call them inexperienced. They don't have, decades of experience under their belt to understand these things. And just to put a final point on this, last week, Bloomberg and CNBC start talking about, oh, it's a new bull market. Why? Because their definition of a bull market is when you get a rally 20% over the low. Okay, so using that measurement, you're measuring 20% off of the October low. Well, let me just tell you something, and here's the final point that I'll make about this. Just using 2000 and 2002 as an example, if you were to listen to the knuckleheads on CNBC and Bloomberg and all of the people that they bring on that do nothing but talk, there were 7 instances back in 2000 to 2002 where you had 20% rallies off of lower lows. Okay, so by their definition, there were 20 bull markets in 2002 through the period 2002. 7. Okay, so that's how you need to be thinking about all of this. Differentiate the market or the flow from the cycle, and make sure that you have a process that can deal with that, so that you're not sitting there holding the bag during a 20% rally off of the bottom.
Yeah, okay, I agree with you, Angelo, completely. There is a tremendous divergence. We see it in the DAX, which is making probably today a new all-time high. We have a recession. They call it the paper recession in Germany, 3 consecutive slowing quarters of GDP. and yet we are doing a new all-time high. And the process that you are referring to, how to manage the divergence between the market and the economy, for that we have Marketimers and our analytical tools.
Yes.
And even when the SVB bank, when it crashed, and we the price action went to weekly low of range. So let me can you see my screen right now?
Yes.
So here we can see that this was the weekly. This is October. This is March. So we were at the low of range, and that was the time to cover your shorts. I did not have a macroeconomical reason to go long, so I did not go long here. But then the ranges start being green on all time frames, right? So at that point, I started to reduce and reduce and reduce my short positions, and I started to increase my position in short-term treasuries, which is now 65% of capital. Of course, I left some shorts, which was a mistake, but you know, nobody's perfect.
Yep.
And right now we are seeing a breakout from a, you can see best on the monthly chart here. It's basically a consolidation from beginning of May 22. So it's a 1 year consolidation, and the longer the consolidation is, the bigger the breakouts are. So right now we are seeing a breakout, and there's nothing to do. You know, you cannot go long anymore. It's too late, and you cannot short into it because you never know how extended this breakout will get, because it's all technical. Markets are technical, and our tools and models are also mathematical and technical, and they are screaming bullish. VIX is in a bullish territory. I mean, you know, 20 VIX is between 20, has been between 20 and now 13 for 3 months. And this is a bull market regime, technically. So yes, technically, signal-wise, we are in a bull market, but the question is how long it lasts.
Exactly. That's exactly right. And David, let me just say something. You don't, everyone gets so fixated on the S&P, the SPYs, you know, SPY. You know, there's other factor exposures out there. Like I chased SPY a little bit. I bought it last week. I sold it a couple days later, and I haven't bought it back since. But I have been long Japan. And I've been looking, and yesterday I sold some. I'm looking at India, because David, if you put up INDA, no, so, let me just back up for a second and explain why India and why Japan. The reason for that is because India and Japan are both in macro regime number 1, which is a really good place to be. The United States is not. The financial markets are doing something different from the actual cycle. So the way I look at things is that if I'm going to put capital to work, I want to do it when the macro, where I have the macro regime as a tailwind, helping me move forward. So Japan and India now are both in macro regime number 1. And for those of you that are unfamiliar, that is when growth is accelerating and inflation is decelerating. So that macro regime 1 and macro regime 2 are the best 2 regimes to be in for stocks on a trending basis.
So I would add how basically you could have used the Marketimers ranges to identify the opportunity in Nikkei first, and then we will look into India. So you have a, again, very, very long consolidation with the top of range around 29,000. You have got a end of April, you have a, breakout. You can see that consolidation index is going under 50. This means that it's no longer in the chop territory or the consolidation, which is above 50. So consolidation index above 50 means consolidation. On the weekly time frame, it went below 50. Visually, you see a breakout. And this is the moment where you start buying aggressively.
Yeah. David, let me ask you a question before you go any further. Did you cover the consolidation readings at your meeting last week? Did you go over all of that?
Oh, yeah, we did that for 4 hours.
Okay.
And I will create a webinar. For me, it was a exercise. And
yeah, I wasn't asking for me. I was just asking for, on behalf of the viewers.
Yeah. So basically, when you have a new trend starting by breakout, you have a new trend starting on the higher time frame. You can start using the daily ranges. You usually never use daily ranges to enter positions. If you are in a chop or in consolidation on higher time frame, because this is a crazy thing to do. You can use them for taking some profits, for risk management. However, to enter positions on daily ranges, which is here, for example, here, here, you do that only when there is a kind of fresh trend on the higher time frame. Then you start using daily ranges for entering the breakout. And for example, and
David, for building a position.
And for building position,
yeah, depending upon everyone listening to us right now should have maximum position sizes for every kind of instrument you trade. So for bonds, it's one position size. For gold, it's another position size. For currencies, it's another position size.
Yeah,
so
our Czech listeners have a webinar for that, and they are using the recommended calculation of sizing from the dashboard. It's basically volatility-based sizing.
Good.
So we have tool for that. We have had a webinar. I don't think we need to go over this today. Just because everybody is really excited about gold, it's touched the all-time high, and everybody is expecting a breakout, and everybody's trying to already buy it. But once again, it's in a really large consolidation. The downside, in case of mean reversion, is very deep. So and like with Nikkei, you need to wait for the breakout, and once the breakout occurs, you start buying dips aggressively from the daily range. So this is something that I'm planning to do with gold if it breaks out, if it breaks above 2000, right? So now let's look at the India. Do you want Nifty or the one denominated in dollars? Because it's a different chart. Yeah,
it is. You use the Bombay. That's fine. The Nifty's fine.
So here we see that, again, we are in a consolidation. We are about to break out, but we still first need to break out, right? On weekly, we can already see it's trending. On monthly, we are already in a trending environment, but we are close to all-time high, and usually at that point people start taking profits, and it can make a pullback. So I would not yet trade it from the daily ranges, but from weekly, maybe. But we have similar situation like in gold here. It's very similar chart.
Yeah, David, you mentioned Poland to me this morning. Why don't you put up EPOL or the Polish Stock Exchange?
Yeah, I will put the Polish Stock Exchange. The week 20. So it's important to look at a quarterly chart. Because you have to understand that Polish stock market is long-term downtrending, but we are still quite far from this downtrend line. If I go back to monthly, we are green on all time frames. The economy there is going well. There was this huge influx of refugees from Ukraine, and those are really, hardworking people, and many of them are educated. They are buying houses, they are buying apartments. I have information from my Polish friends. They're really booming the economy there right now.
David, let me ask you a question about that. Do you know if a lot of these Ukrainian refugees have been able to bring money with them or assets with them?
Oh yeah, they are bringing money. Somebody was telling me who is working in the real estate that most of the apartments he's selling is to Ukrainians. That they bring everything from there. Many of them are educated. It took some time. For example, if you are a doctor, you have to go through some process to be able to start practicing medicine. But lawyers, etc. But they made it happen very quickly in Poland. So there's a lot of educated people, hardworking people, and it's really booming their economy. It's like artificial population explosion immediately. You don't have to wait, 9 months and then, 18 years.
Yeah. It sounds like it's a little bit different when the Berlin Wall came down, and there was the flood of the East Germans into West Germany. And the fear at the time was a lot of inflation. That's what the fear was, because
and there is a lot of inflation in Poland. The inflation is high.
So Poland could be transitioning into macro regime number 2, which is growth up, inflation up.
Yeah.
And that's perfectly fine.
Regime 2. I think that's what's happening there. So basically, yeah, and because we have still a lot of space, a lot of room into the very high time frame downtrend. So, I'm really planning to, because I used to be shorting Poland, and now my bias is long.
Yeah. And the issue, David, hopefully everyone understands this, with most of these markets now, they're all overbought. And in some cases, they're getting very overbought. So whatever it is we talk about today, please don't anybody go out and buy Poland or buy India or buy Japan, because you're just going to get clobbered when the correction comes.
Exactly. That's very important. That we have right now. I need to see week 20 around 1,900 to buy. Yeah. So that is 170 points lower. Of course.
Yeah, and you know what? If we just do the math, let's see, where did it close last night? So David, go back to the trend low of range. I'll use yesterday's close, but
I will measure it for you in TradingView. So basically, it's you have to wait for about 7 to 8% pullback.
Okay.
So this is so basically from the perspective of macroeconomics, the situation right now is that we are in a regime 4, which is basically let's call it recession, and this is
you know what? Let's since you have a lot of Europeans, regime 4 in the United States. And it's probably regime 4 in France, Italy, Germany, Finland, Norway, and probably Spain as well. I haven't looked at Spain lately.
Yeah. So regime 4 is when economy slows and inflation slows, right? So in this kind of regime, usually dollar goes up, stocks go down. and bonds go up. But we are in a different times because we are in a higher inflation regime. So markets behave differently when the inflation is in general under 5-4%. So when the inflation oscillates between 2 and 2.5 or 1.5 to 2, it's different mechanics than if inflation is around 5% or 6%. So and these are the distortions that we see right now.
Exactly.
However, what we are observing is that next quarter, it is possible, looking at the comparative basis and looking at the nowcasts that are available from different sources, that we might see an uptick in economical performance. So in my opinion, the indexes, the markets are front-running economical uptick. Now the question is, once we start getting these, PMI and manufacturing and services and whatever data, the market might be disappointed that the uptick will not be as large as expected. Yeah. So the question is, if the market will lose this up momentum on actually good news, or the rally will go all the way to new all-time high, which is also a possibility, and it really rhymes with the year of 1972, where something similar happened. We just don't know. Also, the inflation will be slower next quarter, and in the fourth quarter, the inflation will almost stop slowing. So, however, the nowcast for fourth quarter tells us that the economy will continue going down. Yeah, we will have uptick in third quarter, and in fourth quarter it will continue going down. Especially if there is no pivot, then that means that these rates will be affecting the economy, because it takes time for the rates to slow the economy. Yep. And basically,
Fed policy, David, operates on a pretty good lag, at least 12 months, 12 to 18.
12 to 18, yeah. So in the fourth quarter, we don't know yet if we will have a regime 3, which is stagflation, or if we have the regime 4, which is the kind of like a recession. So if it's the recession, then the unemployment will finally increase. I think the Fed, what they need to do, they need to really get down the inflation and get the recession over with before the presidential election next year in November. Because so they can, start pumping the economy before election. So this is why it seems to me unrealistic that they would be tightening. However, as we can see from the cross-border capital, their global liquidity model shows that last 2 weeks, and in general since March, the liquidity is going up, and it's uptrending, and it's accelerating actually. Every week global liquidity increases faster. It's probably coming from Asia, Japan, China, and also what they suspect that Fed is doing a lot of hidden or under the table liquidity by, with these programs supporting these banks. Maybe Angelo, you can tell us what's the actual situation with the banks right now. Okay. Are they healthy? Are they already starting to lend money? What's happening there?
Let me just start with, you cannot have a healthy economy without a healthy banking sector, period. But let's just talk about liquidity for a moment. You're right, David. The global liquidity provider that no one is talking about is the Bank of Japan. The BOJ is continuing to maintain their 50 basis point yield curve control on the 10-year JGB. And so that liquidity, a lot of it is flowing into the US. And a lot of it is flowing into the US in the form of direct foreign investment, FDI, foreign direct investment. That's the term, FDI, foreign direct investment. Japan is actually the largest provider of FDI in the US out of everyone. China, not so much. China's not investing here anymore for a whole bunch of different reasons. And, I'm not going to get into that. So as the backdrop, Japan is providing lots of that global liquidity, and a lot of it is coming here to the US, and I'm sure probably some to Europe as well. Now, with regard to the banking system, there are several moving parts to the banking system. The biggest one, as everybody knows, is that the Fed started to raise interest rates. And they raised interest rates a lot, and I mean a lot, 500 basis points in a pretty short period of time. So what that basically did was it prompted people to start taking cash out of the bank and putting it into either treasury bills or money market funds that buy treasury bills. So now you're taking money out of the bank that was earning you basically zero and putting it in a place that's earning you 4, 4.5, 5. And as of today, BIL, which is an instrument that Pete and I like to use, and I think you use it too, David.
Yeah, I use it too.
BIL now is up to 4.86. Okay, and why is that? It's rising because treasury bill rates have been rising. So when you have disintermediation, and that's the term that's used for when deposits are coming out of banks and going someplace else. So when you have disintermediation, the banks have to reduce the size of their balance sheet. And what that means is that they can't lend money. They have to either stop or slow down lending. Now, here in the United States, we have something called the fractional reserve banking system. And what that means is that if a bank has $1 in deposits, a bank can turn around and make a $7 loan. And that process of a bank being able to do like a 7-to-1 here in the United States is where the velocity of money comes from. And if you want to know what that is, you all can look that up and study it, okay? So the fractional reserve banking system here in the US affects the velocity of money, and it also affects the money supply. So if deposits are leaving the banking system, by definition, the banking system has to shrink. Maybe not every bank, but as a whole, the banking system has to shrink. They have no, because they have to give depositors their money, and that money has to come from somewhere. Now, that issue right there is what started to cause the banking crisis back in March here in the US, because now the banks had loans on their books that were less than 100 cents on the dollar. So a lot of banks have mortgages on their books that are 2% loans, 2.5, 3, 3.5. Nobody wants to buy those loans on the secondary market. And so now banks are stuck with that. They can't sell them. That's part one. Part two is where banks own tons and tons of treasury securities of various durations, and the market value of those instruments have declined. So you can see here where the banks are in a box. If they want to raise liquidity, they have to sell a loan or a treasury security. But if they do that, they're going to get a hit to earnings and probably a charge to capital. So that's why the Fed stepped in and created the Bank Term Funding Program, the BTFP. So what that does is it enables banks. See, a lot of people in the BTFP, a lot of people think that's QE. It's not. It's not QE. And the reason it's not, I'll get to in a moment. But so the Fed installed the BTFP so that banks could take their bad loans and their treasury securities and use it as collateral with the Fed. So the Fed will give you, or give a bank, 100 cents on the dollar. The banks won't give you a loan of market value. They will give you original face value. Okay. So if I have $100 million of mortgages at 3%, I can go to the Fed. I can use that I can get $100 million loan from the Fed. But now that creates an issue because I'm earning 3% on that that pool of mortgages, right? But I'm paying the Fed a pretty high interest rate of around 5% now. Because when they instituted the BTFP, the loan rate was 4.8%, but I think it floats. Okay, so now the bank is going to end up with a charge to earnings. Why? Because they're taking in 3%, but they're paying out 4.8 or 5. So that's going to hurt net interest margins. So, you know, you have the bank liquidity side of the problem. You have the earnings side of the problem, right? And the net interest margin side of the problem. And that has not gone away yet. Now, those loans that the banks took from the Fed could one day, David, become QE. How? And I actually think it will become QE because I think that, and these loans, by the way, with the Fed, the Bank Term Funding Program, are supposed to be one-year loans. Okay. I suspect that by the time we get to May of next year, the Fed will probably extend it and say, okay, we're going to provide an automatic 6-month extension or something. Okay. Eventually, if there is no real economic growth, the Fed could just turn around and say, okay, fine, we'll just buy the loans from you. If we hear that the Fed turns around and says, we will buy the loans from you, that's QE. That's when the loans turn into QE. Otherwise, the banks have to repay those loans. Right now, there is nothing on the horizon that tells me that the banks will have the cash flow to be able to pay back those loans. The only way the banks would be able to pay back those loans is if we end up in a severe recession, interest rates go back down below 2%, and the value of their treasury holdings and the value of their loan book goes back to par. And then they can turn around and pay back those loans. But right now, there's nothing on the horizon that says to me that the banks are healthy, that the banks are lending. In fact, they're lending less. And just in the last couple of days, you know, the banks have been having conferences. And, you know, Discover Financial, which has a big credit card loan book, Capital One, which has a pretty big credit card loan book, 30-day delinquencies on credit cards is rising. Now, what does that mean? It means that if they keep on rising and the delinquencies go from 30 days to 60 days or even longer, the banks will have to start doing charge-offs. And when a bank does a charge-off, they're increasing their loan loss reserves, which means their earnings crash. So that's happening right now. So credit cards and car loans now, the delinquencies on both of those are starting to rise. That's not good for the banks. We have the real estate part of the cycle. and we've probably talked about this in the past. The real estate part of the cycle is going to be, the refinancing. We have what, $2 trillion of real estate loans, not individual mortgages, but real estate loans like office buildings, industrial parks, that sort of thing. There's roughly $2 trillion that has to get refinanced between this year and next year. Well, at these interest rates, if you're going to go from a 2% or a 3% interest rate on your office building to a 9% or a 10% interest rate, that math doesn't work. And we've already seen instances where big institutional players have already handed the keys to certain office buildings back to the banks. So we have this credit part of the cycle, everything from credit cards, car loans, individuals and the mortgages on their primary home, the real estate refinancing cycle. All of those factors have not yet really dug in, not yet. So if and when the credit part of the cycle starts to kick in, thanks, Pete. Yeah, I thought it was 1.7 trillion. I rounded it up to 2. It's still a lot of money. That's a lot of money, right? So all of the banking stuff is operating on a lag. And that's probably one of the reasons why, the flow is behaving differently from the cycle, because right now the economic cycle is sort of in no man's land. It's in limbo. It's waiting for the next shoe to drop, right? And the next shoe to drop, could be the credit part of the cycle. Now, here in the United States, we have something else that's going to take effect. It's not a really big thing, but when you add it on top of everything else, look, what causes an avalanche, right? That final snowflake that lands on the snow pile triggers the avalanche, okay? So the student loan issue here in the United States, starting September 1st of this year, everyone that has a student loan has to start making payments again on their student loans for the first time in 3 years, I think it is. Okay. Now, what have they been doing with, and the estimate is that the average student loan payment is somewhere around $300 a month, somewhere around there for undergraduate, and it's higher for graduate degrees. So just using $300 a month, that is going to put a crimp in people's ability to spend money on movies, dinners, vacations, right? Going out to eat. It's just one more thing that makes it harder for the consumer to spend. And as you know, David, retail sales are awful, absolutely awful. They're really, really bad, which is why the retail sector has been such a great place to put on shorts so far this year. All right, so I'm going to call this, we're in a bit of a no man's land. And we have more stuff that's going to be coming at us in the next 2 to 6 months, and we'll just have to see how all of that plays out. But the banking sector is not healthy at all. So 2 big banks that came out just in the last couple of days, KeyBank and Fifth Third Bank, they're both like among the top 20 banks in the United States. They both expect their net interest margins to decline a lot. In fact, KeyBank, their net interest margin from the first quarter to the second quarter went from down 4% to down 12%. A bank can't make loans when their net interest margin is declining, and a bank can't make loans when depositors are taking money out of the bank and doing other stuff with it. And that's how I see things as far as the U.S. banks go. And Fifth Third Bank too, another big bank. took down its loan growth outlook as well. So what people don't recognize, and this is important to understand, if loan growth is flat, okay, if loan growth is flat, that means that economic growth is contracting. The only way economic growth can accelerate is if bank lending accelerates. It's really that simple.
Okay, thank you, Angelo. We have last 10-15 minutes. So I will just go over what's happening in the actual markets. Basically, what we are observing is a rotation from defensive, from low beta, from from dividends into high beta. First, it was going mainly into profitable, kind of a defensive tech, defensive high beta, right? But this week we already saw the May stocks, plug and UPST, whatever it is, started rallying. So so it's now going. But this is every bear market rally last year happened like that, and basically the profitless shit stonks, or how to call it, those would rally a lot. Then the momentum would disappear from those, and after that, later on, the momentum would disappear also in the major indices. Another fact is that both SPX and NASDAQ, they rallied above the 62% retracement of the bear market, which makes it technically possible that they can, target all-time high. It happened in DAX. So, the rally is overextended, and we don't know where it stops. So I'm not at this moment shorting against this momentum. I'm waiting for pullback towards 4,305 or so. And then I will be observing if new buyers come in and they will try to make a new leg and go higher, because next quarter we will have economical uptick. So, this breakout if this breakout has a further leg, then we are going to all-time high, definitely.
Yeah. David, let me offer a counterpoint.
Okay.
If we don't have to do it now, but if you start analyzing the currency crosses, if you look at the Mexican peso versus the yen, the Mexican peso versus the yuan, Aussie yen, so on and so forth, this morning we were seeing some matchups with roughly 44.54 on the September S&Ps. And there was some big levels that were showing up in the currency crosses that were suggesting that maybe this could be the end of it. At the very least, if anyone's long, this would be a spot to exit the longs and see what kind of a pullback we get from this level. So basically, just watch 44.54 in the September ES. David, I think you're muted or something.
Yeah. So the June contract is now basically copying SPX. There is a minimum spread. But today, before the FOMC, they tried to get to 4,400, but they didn't manage. We'll see. Maybe they will get there by the end of the month. Anything can happen. So for me personally, I'm not adding to my dollar position because the dollar index is in the middle of chop. Moreover, the nowcast for December or for the fourth quarter, we don't know yet if it's going to be stagflation or recession. So I'm waiting with US dollar at least to get a better entry position, because now it's in the middle. And when it comes to indices, I want to see a pullback to, on SPX, I want to see a pullback to 4,305. Then we'll see, buyers will try to step in. And then I want to see if they're successful or not. If not, I'm going to start shorting again. Probably better short will be signal-wise, better short will be Russell than S&P.
Yeah, Russell, banks, and high yield credit.
Yeah, but banks
and maybe retail as well.
Yeah. And banks are still not at a good location for big short. So it just needs this stuff needs more time. And we have somebody raising hand. Yeah. So in general, indexes are extremely overbought, but a lot of them are bullish trend. So it's difficult to short against that. And the things that are bearish, like oil, they are at the low of range. Bonds are at the low of range, and but they are bearish trends. So in that case, if you will go long, you are catching a falling knife. And we don't have. I was searching and searching. I didn't find one single ETF or market that would be in a sweet spot for execution, unless you want to be, playing intraday matrix levels or something like that.
David, the only index I saw today was the Russell at 1907, the 400-day.
Yeah. Russell was at the top of range. So let's look at Russell on the dashboard, IWM. So very important reading is very high consolidation index, almost 62 on the monthly. On the weekly, it's 60. So above 50. Okay, about 50. It's consolidation, and we got to the top of range of the consolidation. And I already mentioned it today in our Czech language chat that that's the best market to short. As you can see, Russell today is the weakest of all the markets.
Yep.
Sorry. You have to unmute. Sorry, I muted you by mistake.
Hey, Pete, did you have a question?
Oh yeah, I just sorry I was late. I got tied up with a couple of meetings, and one of them was unexpected.
Okay.
I just want to say that a lot of the data that we see, the macroeconomic data, like the index of leading economic indicators, are widely distributed and widely known. And there's been a lot of defensive positioning by by professional investors and fund managers. And that means there's a lot of money on the sideline. And I feel it's important that they're now looking wrong, and to protect their jobs, they have to chase the market. And what does the macro information matter? It matters when the news, the macro news that comes out is worse or better than what the market expects. So right now, they're starting to get a lot more cheery about the outcomes for things over like next year, for next year. We're working from data which says it's the recession risk is only rising as we go into the end of this year and beginning of next year. We're working from macro assumptions that once joblessness starts showing up, that consumer spending is going to collapse and then more joblessness. But that's not the fact yet. And now it's become more important for managers to not be on the wrong side of the market. They have a lot of money to chase with. So you can build an understanding that, David says possibility for new highs, where all that buying would come from, just being people forced to buy because they're afraid of missing out, afraid of being fired as a money manager.
100%, Pete. And everything.
And I think David's correlation work is going to be one indicator that tells you that the sentiment, the flows in the market are flipping bearish.
And everything
Let's look
Pete
at
just
the
said,
correlation
is-
work. Right now, it's on the screen. As you can see, the short-term correlations, this is 1 week. So this is 51-hour periods. It's especially the macro correlations are not picking up. So we don't see risk in the markets. If we look at 54-hour periods, which is a longer period, the cross sector correlations, which we see here, this is like SPY with QQQ, IWM, XLI, XLF, XLP, XLE, XHB. So the Fisher price correlation matrix is higher, but the macro correlations are just not there. Bond correlation to NASDAQ is negative, which is not what we want to see in a inflationary bear market. We want to see that bonds are dragging indexes down, because bonds down means higher yields, which means economical problems. So the correlations are not there yet, and we just have to wait. But however, the current state of correction shows that we can have some pullback. I mean, as I was discussing, pullback to 4,300, and then we will see what happens there.
Yeah.
Okay, back to Pete. Sorry.
Yeah, but everything Pete said speaks to our conversation at the beginning, whereby the flow is doing one thing and the cycle is doing another for now, until eventually they come back and converge.
Yeah. Okay, well, thank you very much, Angelo. Thank you very much, Pete. It was great to hear you. I just give you feedback from our meeting in Mikulov. That one of the things that people view very highly when I was asking for feedback about the Marketimers. So the senior traders floor is something that people really enjoy the most, and they enjoy Angelo's and Pete comments, and they have you in a very high regard. So thank you very much, for your participation, and I hope that you're also enjoying being with us.
Totally, absolutely.
So have a good day, and we will keep communicating.
I've enjoyed it very much, and I'm sorry I don't know any Czech, but
we know English. Don't worry.
All right.
Okay,
See you
so
later.
see you in Discord.
Okay, bye.
Ciao.